Hi, everyone. Welcome to the Capital Raiser Show. I'm your host, Weston Walker, and we interview only the best entrepreneurs and investment managers. Shout out to the sponsors that make this all possible, the Family Office Club, Capitalist Pro, and Invest Next. Today we have Stephen Pesavento, the founder of Von Finch Capital, multifamily asset management group based in Denver, Colorado. He's bought over $550 million of multifamily, primarily in Denver and the Midwest markets. Stephen, welcome to the show.
Hey, super good to be here, Weston.
Of course. Yeah, so we met in Phoenix and we were talking about the sales opportunities and raising capital. So you've obviously raised a lot from high net worth investors and started this business in your 20s. So could you go into your background of how you started this firm and the vision that you had, starting such a large multifamily group?
Yeah, so it's interesting to look at where we are, over $500 million of real estate, and then look at where we came from. And, I started my career in management consulting, born and raised in the Midwest, Minneapolis kid, and, oldest of four kids. And so, growing up, I had a realization, I wanted to make some money and, have fun doing it, and wanted to kind of get away from that. The kind of the way you're brought up when you don't have enough, if you say it like that. So I started my career in management consulting, thought, if I go the typical path, go to school, get a job, work for a 401k and a gold watch. And within about a couple of years realized, that's not it. So I moved from Minneapolis to Boulder, Colorado to work in tech, a lot of tech startups here in Colorado. And within a couple of years, I learned a ton about running business, growing business, worked on my own startup. And then that led me to realizing, hey, I want to work on something that's real. In tech, there's a lot of funny valuations. It's all about your next raise. It's not so much about building a profitable company. The hope is that, something on the back end is going to make it, the next Facebook, Uber, Airbnb, which is what made real estate so attractive. So, just like the way I do everything, I went all in, fired all my clients, had no other way to make income, and just decided one day, hey, I'm going to go and buy real estate. So I started going to some events. I found some people that I could trade my skills to learn from them, kind of a mentorship trade opportunity. And within about 12 months, I had bought 75 houses in 2 different states. And within 2 years, I'd bought over 200 single family homes. All of those were bought off market. I'd bought over 125 houses before I bought my first personal home, the only property I ever bought through a real estate agent. They were acting like a wholesaler, but, and then that really kind of led to this transition of realizing, okay, well, I'm buying in 2 different states. There's a lot of risk. I'm taking on a lot of debt. I'm borrowing capital from private investors and raised about $26 million of private credit to enable that business and buy those homes. And that's really what led me into commercial real estate, buying multifamily, kind of same philosophy. We're looking to buy deeply distressed projects that we can come in and renovate and reposition and, take somebody's problem and turn it into, a profitable solution for our investors. And, so over the past 10 years I've bought, $500 million of real estate. The way my business is structured today is I've got an incredible partner on the construction property management side. He lives and breathes, renovating and repositioning properties. And it's the same way I set up, the first iteration, Von Finch Homes. My partner was a longtime developer, had the gray hair, had been through it before. And so at the core of my philosophy is find really smart people who've got experience and find a way to get aligned with them. And so, that's what we're doing today. And, we raise a lot of capital from individuals and small RIAs and family offices and, other people who are putting capital together in some kind of allocation vehicle.
Yeah, and then building that $26 million starting your fundraise for your company. Tell us your journey from raising that initial 26 million and what you would do differently knowing now to possibly raise that easier and build your company from there.
Well, I think like the core of my belief system is, hey, if I can put everything I have on the line and I can find somebody else who has some value that together we can do something great, and create that way of alignment. And so, if you think about the way that I started, I was, sub 30 years old, 26, 28 years old. I'm willing to put in the time, effort, and energy, but I don't necessarily have my own capital. And so, the way that I went about it was I found like I said, a partner who had extremely deep background, a lot of relationships, and most importantly, a track record and experience. And so, the way I went about it was we were 50-50 partners. We started the company from scratch. It was my vision, his experience, a lot of my sweat equity and his brains and knowing what we're looking at. But I really use that as a tool because, who's going to lend money to somebody who's 26 years old who doesn't have a track record? So I would essentially say, hey, my partner, so-and-so, you know him, he's credible, he's got this experience, look at what he's done, and this is what we're doing together. I think you should take a look at it, and here's the advantage, here's the benefit. And so one investor turned into two, into three. We even turned people we bought homes from into investors that still currently invest with us today after doing seller financing and, carrying the note to one property to another, and then eventually investing in our equity deals. And so the thing that I would give to advice to people who are starting out or kind of earlier in their career, and even for people who are as experienced as I or well more experienced is, I'd look at it like, what kind of alignment can I set up that as the end result that I'm looking for, that person is going to get what they want and I'm going to get what I want. And we both carry the risk of either party not being able to deliver on that result. And so with that kind of alignment mindset, and if you think about things for the long term, who you are and your character and doing what you say you're going to do is kind of the most important piece, because when it comes to raising capital, the things that are important, of course, is the deal and the numbers, but I never sell the deals and the number. It's about the relationship. It's about being able to connect with somebody on a personal basis, even if it's at scale with many people through podcasts, webinars, advertising, other things like that. At the end of the day, it's a person-to-person connection. And so that person-to-person connection is built on trust. And so that means transparent communication. That means, answering people's questions. That means doing what you say you're going to do. That means under promising and over delivering. And then even when things don't go well, because nothing goes perfectly, and investment, of course, has risk, it's being that person who is going to stand up in front of your community, your investors, your clients, your partners, and be able to say, hey, this is what didn't go well. This is why it didn't go well. This was my responsibility in it. This is what's caused by the market, and be able to have a honest communication on a consistent basis, rather than what unfortunately so many people do is they kind of hide out. They aren't sending those communications out. They aren't discussing those things in advance. They aren't talking about those problems. And frankly, some of the best investors that I have are from some deals that didn't go well, because I followed through on my commitment and they made what they were going to make, and it came out of my pocket. And I didn't do it from the perspective of, hey, this is going to be a long lasting good thing. It's just like, oh, well, this is what I think is right to do, and therefore I'm going to do it. And then ironically, those people follow you for forever.
Yeah, and just communicating honestly with those people. And I've never heard people coming back, after they've had a deal going wrong, and the reason being is because you communicated honestly with them. So talk about building trust and raising capital at scale. Obviously you've built your team, you've built your operations, you built your deal flow. So talk about kind of the phase 1 to phase 2 of starting Bond Finch Capital.
Yeah. So kind of where we're at today, just personally, I've raised over $80 million in private credit and equity. And what's interesting about that is, over $30 million of that's in the last 2 years. So during the most difficult capital raising environment, a single individual with a small team has been able to go out and raise capital. And really the way that I look at and think about doing that, it goes right back to that personalized approach. And so, strategies include finding ways to get in front of people. So you can go to events, you can run paid advertising, you can get in newsletters, you can speak at events on stages in front of people, and you can take meetings and in-person events that you're hosting yourself and kind of creating your own community. But all of those things together end up leading for an opportunity for you individually, personally as the principal, or your team, who you've hand selected, coached, nurtured, mentored into being able to think and communicate the way that your vision and values align. And through that process, we get to know people on a deep level. When we're bringing in capital, we're understanding, what does that person do for a living? What have they invested in? What hasn't gone well? What's their investable assets look like? How is that divided up? And we look to be a trusted advisor, to be able to kind of share ideas with them, talk through things that aren't even relevant to our platform that might be of value and service to them. And then through that process, of course, we're going to be able to share the ways that we think we can add value and the projects and things that we do. But I think one of the most important things within that is that, you kind of flip the script. It's not a sales process, right? Everything is a communication process, but it's not about pushing somebody into something. If anything, it's pushing them away. It's pushing them to say, hey, I don't think this is the right fit for you. I think you're going to be over allocated here. Because if you can gather enough information and somebody understands that you are looking out for their best interest, at the end of the day, when somebody invests with a sponsor, they're not investing in the deal. The deal matters only to confirm the trust that was already built, because at the end of the day, it does come down to the operator and how they're going to actually execute and do what they say they're going to do. Because everything's great during good times, but when the market changes, you got to be able to adapt quickly. And that's where you really get an opportunity to see who people are. And it's a great example that if you work with high net worth, second, third, fourth generation families, the way they look at investing is they have a very long time horizon. So they're in no rush. They'll sit and watch you for a few years to see how things go, how you're communicating, what you're doing. And as a smaller investor who's writing a $100,000 check or a $250,000 or $1 million check, who isn't writing a $50 million check, maybe you don't have the luxury of being as patient, but that's why it's super important to be upfront, communicate, both trust your gut and intuition, as well as, asking the right questions to validate what you are going to expect from that person. So, just to summarize, I really think it's all about communication. It's about being able to get out there in front of people and share your message about how you're different. And some of those people are going to resonate with it. Some people don't resonate with the idea that we're looking to build relationships. Maybe they're skeptical. Maybe they think, oh, hey, how is this person trying to screw me over? Or how are they trying to get more of my check? Versus the perspective of, hey, we want to build a multi-decade relationship with you. And we only do that by having the first investment. But the first investment doesn't matter. What matters is the 10th investment, because that's where they're really making money. That's where you're really making money. But the core thing is, if you know who you want to work with and you're willing to turn people away who aren't a good fit culturally, economically, socially, whatever those things are for you, and you're willing to turn those people away, what the end result is, you're going to attract more people in who actually align with who you are, and how you want to do business.
Absolutely. And often when you push them away, it builds trust there too, because some groups are so needy to raise capital that they push people to invest, and they, double text or triple text, and it just doesn't work that way. So talk about how you managed your multifamily deals through the higher interest rate environment. A lot of sponsors have had trouble, especially in the Sun Belt states where deals have gone south, maybe in foreclosure or forced sales. So talk about how you've, operationally, stabilized those deals through the tough times.
Yeah, it's a really good question. I think at the core of it is understanding what you are the best at and who else needs to be filling in on those gaps. And so one of the things we had done is, just like many other people, as they're transitioning from one sector to another, they start partnering with different folks. And I've partnered with a couple different operators, as we were trying to get some exposure personally for my family's money alongside the stuff that we're doing directly. And it was actually a mistake. The mistake was that, I started my career and built my experience being in control, making the decisions, being the one who pulls the trigger on what happens. And there's a couple examples of projects that we did were with people that we didn't have that kind of control. And so fortunately, those were minority positions. We're talking a couple $1 million on a $80 million portfolio of equity, right? But those are great opportunities to learn. And so, the takeaway from that really is, if you're going to be in a position where you're not in control, where you're an LP or you're a fund manager, it's critical that you build a deep relationship with that sponsor, that partner, and that you understand what it is your role and responsibility is, and that you are truly aligned. And so, we essentially pivoted back to being in total control, having full decision rights, being able to make decisions at the property level. The other thing that we did was we immediately, as soon as interest rates started going up, we immediately went to every project, whether we were in control or not. We had our asset management team run analysis on reserves, and we started pushing everybody, including the deals that we are in control and the ones that we're not, to stop distributing, to be ahead of the curve. And there's a couple examples of people who did not want to stop distributing, but because we were such a loud voice on that and our data was good, they did. And as a result, those groups did not have to do capital calls until just recently. And so the way that I've looked at it, the way that we've operated is we've worked to cut all expenses that were not, going to lead to immediate revenue. We started dialing back CapEx spend. We essentially underwrote every single deal as if we bought it today and thought, okay, well, what is the best strategy? What's realistic when it comes to rent growth today? Oh, we actually need to start underwriting negative rent growth because that might be the environment we're in. And so as a result of that, we did end up cutting a pretty significant amount of our CapEx budget on most projects. Now, there was a few that it was important to do that CapEx spend and that it was going to end up leading to faster stabilization and realistically put us in a better long-term position, especially to wait out this down market. But at the core of it, it's immediately realizing that the rules on the game board have changed and that it doesn't matter what the old game you were playing was. We're playing a new game. And just like in any board game you're playing, if you're not aligned with the rules, you're not going to be aligned with the outcome and the success. And so that focused us and forced us to really slim down where we're buying. And that led us to doubling down on the Midwest, where we have operational, expertise. We've got a full in-house property and construction management team, as well as in Denver. And the interesting thing is that 2 years, almost 3 years ago, we started that process. And now we're seeing some of the biggest groups in the country start to push into the Midwest because they're starting to see the market movement and metrics that we had been seeing for years. And so as a result, we're in a great position with our current portfolio. If anything, it's getting harder to get great deals, but because of our experience in those markets, we've still been able to close. I think last year we closed right around $55 to $60 million of real estate, in a market where most people aren't able to get deals done.
Absolutely. Yeah, and talk about the operations and how that's changed over time. Obviously when people start, they go into third-party management, property and construction management. So talk about how you brought that in-house and how you've made your firm more professional.
Yeah, and so there's a few deals that will still do third-party management, and I think there's some benefits to third-party, so I'll talk about those. But the benefit of doing in-house property and construction management is that you truly are controlling your costs. I mean, one of our unique advantages is that the cost of our construction is 30 to 50% less than when you general contract something out. And that's because we've got almost a decade of relationships with Latin labor that we've been working with for a very long time. And we don't go and find the people who are running like sophisticated businesses. We go and find great tradespeople who want consistent work, and we give it to them. And as a result of that, they charge us a lot less. Maybe it takes a little bit more construction management time from our perspective, but that ends up leading to, significant outperformance on the deal level. And when it comes to property management, because we're controlling all the expenses, we're able to run property management at a break even or a loss in order to support those projects where most other firms are not going to be able to do that. Now, the advantage of third party is that if you find the right third party manager, and it comes down to the right regional that's going to oversee and lead that team, and you are able to align with those people and manage them really effectively from an asset management perspective, you can get great results, and it can allow you to move into new markets more quickly based on where the opportunities are, versus with a vertically integrated PM team. Now we've got to go and hire all these people, implement strategies to move our team down to those markets as we start setting up scalability. So, for example, about a year ago, we closed on 2 projects in Omaha, and we had been looking at that market for about 18 months, but we needed a project big enough to support our PM team traveling down to that property, even though it's only about 90 minutes from our office in Des Moines. It did take getting a sizable project in the portfolio and a couple other assets to be able to justify that. But the advantage of third party is if they're not doing their job, you can quickly iterate and fire them and replace them. But that obviously leads to some downtime. It's pretty difficult to fire yourself as the third party property manager. So there is some pros to it and there's some risks. Now, in our case, everything we care about is the promote. And the promote is what the investor should care about because that's how they get paid. So, we run all of our services, at a loss or break even with the goal of being able to generate higher promote because it's better from a tax perspective for us. And it obviously leads to the end result, which we care about, which is investors who are happy, who reinvest. So that's kind of the thought process. Now, if you think big picture, third party can be incredible. It allows you to scale a lot faster. But then what you really need is super good, talented asset managers because they are essentially managing somebody else's employee to get them to do what they want. And that takes some really good leadership skills as well as being willing to have the hard conversations.
No, absolutely. Yeah. So you've obviously gone to, over 500 million in assets under management. Talk about the future of your firm, maybe getting to $1 billion or $2 billion. How do you plan on raising that capital, building your team, and finding those deals?
Well, I think the other thing that's kind of notable, that's different about our firm is that, we really cut our teeth buying like middle market multifamily. And so in the Midwest, that's 100 to 150 units. That's a sub $15 million purchase. And in Denver, that's sub 50 units. So, we've bought in 50 plus deals, probably going on 60 plus deals at this point in the multifamily sector. And we've had 25 exits and our IRR is kind of out of this world. But the reason that it's out of this world is because we're buying stuff that's not scalable. You can't put out a $30 million equity check very quickly when you're buying smaller assets that are say 5, 10, $15 million. But the advantage is you can have, double digit returns very effectively because it's not scalable. So the Blackstones of the world are not going to go buy a $15 or $25 million property, but we can double our money in 3 years doing that, even in this market, because other people are overlooking that. And so when it comes to, our vision for where we're going, it's definitely, we're at a point where our track record is solid and we want to keep doing those kind of deals because frankly, the faster that we can turn through the capital, the faster someone has an experience with us and the faster they're going to refer 5 of their friends and they're going to reinvest. But then also selfishly, it's building our balance sheet. I don't come from, super wealthy family. My partner doesn't either. But real estate's been a really strong vehicle for us to build that balance sheet, which allows us to obviously do bigger deals and get bigger loans. And as we continue to scale, we'll start doing those types of projects that maybe don't create a 50% IRR or 100% IRR type return. But as a result of that, we'll be able to put on more AUM, more units, because it doesn't require as much brain damage to turn those projects. So, our unique ability is to go and buy a project for 10, 15, $25 million and renovate all the units and raise rents by 30 to 40% up to market or beat market rents. Of course, we're underwriting to a much lower number than that. But that's been our unique advantage, which has driven the ability not only to raise a lot of capital, but to create some pretty outsized returns. But when it comes to scale, there's a limit to how many of those projects any firm can take on at one time because of the specialty that it takes. So one of the platforms that we're working on putting together is more of a core plus offering, where there's kind of a light value add strategy, but it's more cash flow focused, and the returns are, 15, 14 IRR instead of a 20 plus net to LP. And so those are the kind of things that we're focused on as we move forward. But truly, I think this business grows organically without force. Like if you do well by other people, you're going to take that 50 or $100 million AUM and you're going to double it every 3 to 5 years, even if you're not pushing super hard, because people are going to see a result. They're going to reinvest. They're going to share it with a couple other people, and whether it's 1 in 10 or 1 in 5 people refer, that compounding effect does inevitably lead to a great result for the firm and for those people who are participating.
Yeah, and it seems like it compounds when you just generate those results for investors. So, Stephen, talk about what you're looking for currently. Maybe if someone's listening to this, they have capital, maybe they, want a job in the real estate private equity space, or they have a deal to share with you. Talk about what you're looking for specifically and how you can help.
I think there's 2 things I'm always looking for. I'm always looking for people who have a unique set of skills. They understand what they're the best at. They understand what they're not the best at. And they're looking to be an entrepreneur in an entrepreneurial organization. They want to take full ownership. They want to put the company first. Putting the company first is putting the client first. And they want to put us in a position where they have an opportunity to create great results for themselves and take full ownership and participate along the way. So I'm always looking to recruit great people. So if you're interested, find a way to get in touch with me. If you're good at what you do, you'll figure out how to do that. But we're also, we've built quite a platform, 100% raised internally. And we work with a couple allocators, couple fund managers, couple RIAs who've got their own platform that are allocating into deals we do because of the level of care that we bring to that. So we're in the midst of putting together more of a platform for those allocators who want to be able to create a great return, have a product that they can sell with a partner that's got a great character, and be able to do that. So if you're listening to this and that's something that's of interest, it's worth a conversation. Reach out. We've got some great people on our team who can talk through that, and obviously you'll have an opportunity to meet me if it's a fit.
Awesome. Yeah, and talk about the best way to get in touch with you guys.
Yeah, I mean, the best way to get in touch, if you want to learn more about the platform and what we're doing, vonfinch.com, a lot of information on there and a lot of information that's not. So you got to kind of get behind the portal into the insider group where we share all the information with people that are vetted and the right fit. But go on LinkedIn, shoot me a direct message, connect, find a way to get in touch with me if you want to do some business. We're fortunate to be able to choose who we do business with, but I'm always looking for people who are hungry. They want to change their life circumstances and they want to do it from a go-giver mentality.
Awesome. Thanks for coming on, Stephen.
Appreciate you.